Well, I think cautiously optimistic is a good way to put it. Certainly, we've had a better year than any of us expected in 2019, and we believe that investors have discounted forward a resumption of growth next year. So we're thinking maybe 6 to 8% more in U.S. equities in 2020, assuming again that resumption of growth occurs.
Michael, a lot of the headwinds that we were talking about in 2019 are falling by the wayside. The trade war with China. We've got the trade deal now with Canada and Mexico. The Fed is self-proclaimed out of the way for a while here. Growth overseas is starting to pick up a little bit. It feels like I mean, what could go wrong here, I guess, is what I'm asking.
Well, you're right. I mean, at this point, my only point would be when things look that positive, look out.
Exactly.
But, I mean, the risk factors are clearly defined. They're subsiding. And I think going into the new year, recessions generally don't start with this sort of fact pattern. So I think initially it's a good period. I think as the year moves on, though, you're going to have the U.S. elections taking precedence. You'll have issues with respect to Brexit. You'll have other elections going on globally. You've always got geopolitical risk. I mean, look at what's going on in Iraq today. So any one of these risk factors could be the first domino to changing the dynamic. But at the moment, you just don't see it. The other thing to keep in mind this year is that not only did equities have a good year, but every asset class seemed to have its day in the sun.
Right.
Precious metals had a good run this year. Gold is up about 18%. Even bonds had a great run as interest rates went the exact opposite direction everybody thought. So it's unlikely that all of these things will happen again exactly the same way in 2020.
If anything lagged, it would be the oil stocks, which maybe we can get to. Rebecca, what's your theme for next year? I mean, and which stocks will fill that theme for you, fulfill it?
Well, we are still overweight U.S. equity even in our globally balanced portfolios. We prefer technology, understanding that it's considered expensive. We like software within technology. In the industrial space, we like machinery and some of the defense names. And we've also added back some dividend-growing utility type things as buffer in case we hit a bumpy patch to the downside.
All right, Michael, your theme and which stocks or sectors?
Well, on the equity side, it would be areas that haven't kept up and levered to growth. So if you get a global growth story resuming, then that will likely decrease the value of the dollar, which will make emerging markets and non-U.S. for the first time in a while probably be better performers. I mean, investors have been going broke waiting for those markets to take off. And that's why the U.S. has been so good for the last several years. We see the U.S. continuing, but we also potentially see broader participation globally if the global growth story takes off. Financials, transports, industrials, materials, energy, those sorts of things that would be levered to growth versus consumer staples and some of the things that would be more in a recession-driven type situation. On the fixed income side, interest rates are somewhat uncertain, so we're still relatively short duration and high-quality balance sheet. And we like precious metals like gold and silver, whether you've got a growth story or a recessionary one. We think those assets hold value regardless.